So Warren Buffett has actually been busier than I thought this year, and there are actually 10 major stocks that he spent billions on in 2025. So according to Motley Fool, they have actually spent $3.9 billion investing in 10 different stocks. And we went over a few of these already in my last video about what Warren Buffett's been up to in 2025. That's United Health, Nucor, and Lennar. Now we actually have 7 more on top of those where they've been buying apparently in 2025. So in case you missed the last video where I went over these first 3, I'm going to kind of go over these a little bit and then we're going to get into the other 7 that I haven't covered yet. So the first company that I've already mentioned, but they actually bought almost controversially this year is United Health Group. United Health Group's had a lot of problems. They've had some regulatory scrutiny, Medicare issues, leadership turmoil, of course, and shares tumbled over 50% in the last couple of years. If you look at their stock here, they're down 46% just in the past year. So they think they are underpriced, and their PE ratio is quite low. They have a nice dividend yield. And so as far as healthcare stocks, they decided to buy into United Health Group, which over time has been a pretty steady stock. It's just that a lot of things have happened in the past year that has made their stock plummet. Now, if they actually recover over time, if they get anywhere close to their all-time high, which would be, right around $600, that could be doubling the investment. And ever since people found out that Warren Buffett was buying, a lot of other people have been buying, as you can see with the rise over the past month. Now we have a couple other stocks that one of them I have mentioned, but we have a couple of different ones that are related to home builders. So he's invested in a couple different home builder stocks. One of them is Lennar. So Lennar, as you can see, they're down over the past year. They're still up pretty well, just under 99% over the past 5 years. But their PE ratio is very low with this one as well. Dividend yield is a nice 1.4%. Not a ton on the dividend yield, but still a solid dividend. And apparently Warren Buffett bought 7 million shares in Lennar. Again, Lennar is an American home construction company based in Miami, Florida, and they're the second largest home construction company in the United States. Another one very similarly is D.R. Horton, one of the biggest home builders in the United States. They're an American home construction company based in Arlington, Texas. Since 2002, the company has been the largest home builder by volume in the United States. So basically, he bought the 2 largest home builders' stocks, and he has 1.5 million shares in D.R. Horton. 14.75 PE ratio is pretty low. Dividend yield, not super high, but if you look at their growth, they've been a pretty high growth stock. So there have been some high rates and affordability issues in the short term, but long term housing demand seems to remain pretty strong, at least as of right now. Another one that he invested in is Nucor. This is another one that I had mentioned in the last video about Warren Buffett. It is down 2.21% today, but year to date they're up 25.8%. Up 2.2% in the past year, so not much growth there, but over the past 5 years, really strong, 213.56% growth. So this one was a 6.6 million shares in Q2, valued at around an $860 million investment. Now, Nucor is an American company based in Charlotte, North Carolina, and they produce steel and related products. They happen to be the largest steel producer in the United States. And of course, with all the tariff stuff going on, I believe the steel tariffs are actually one that is not being taken to court on whether or not it's legal. So we do have obviously a lot of tariffs that could be taken away, and they may have to refund many countries because of that. We don't know what's going to happen yet. But I believe the steel tariff was one that's going to stay in place no matter what. So international steel imports are going to be taxed like 50% for tariffs, which gives a nice boost to American steel manufacturers like Nucor. So Nucor, they have a 26 PE ratio, a 1.53% dividend yield, but this news about them, obviously being the largest steel producer in the U.S. and with the 50% tariff on imported steel from outside the U.S., that could be a strategic advantage for Nucor, at least during this administration. Now, we also have Pool Corporation. So they are a company that does wholesale distribution of swimming pool supplies, equipment, and related leisure products. So Warren Buffett more than doubled their position at 3.46 million shares, which is now worth about $1 billion. So this is kind of a cash-rich, predictable business. And again, this is pools, leisure products, and things like that. Now, they haven't really done a whole lot over the past 5 years, only up 11%, down in the past year, mostly down the past year in general, no matter what period you're looking at. The past month, they're up a little bit. Maybe because of this news, they'll go up a little bit. When Warren Buffett, buys something and news gets out, a lot of times there's a little uptick. But PE ratio 30.79 is a little high compared to their growth, and dividend yield it's hard to justify like having that as the dividend yield versus owning something like SCHD. So I'm not so sure about this one right now. I'm not really sure what he sees in this, especially if after the latest job report, if the economy starts going into a recession. I'm not sure a lot of people are going to be buying pool and leisure products. Now we do have Lamar Advertising. So this is another one that apparently he's bought this year. A newly disclosed position of about 1.17 million shares. So this is an outdoor advertising company which operates billboards, logo signs, and transit displays in the United States and Canada. So you're talking like in-person advertising, stuff that you see on the side of the highway, things like that. So this is just kind of a diversification from digital ads, of course. If you look at the past year, they're up only 4.49%. Past 5 years, not bad, 103.8%. PE ratio is right under 30, but it's got a really nice dividend yield. If you actually look at their growth over 5 years, plus that really nice dividend yield, which is actually higher than the SCHD dividend yield, then you're looking at maybe a pretty solid stock over time that's kind of flying under the radar. Apparently, he actually bought 780,000 shares in Allegion as well. Allegion PLC is an American-Irish domiciled provider of security products for homes and businesses. They actually have 31 different global brands under this company. They also have things like security hardware, access solutions for businesses, and they seem to be more of like an infrastructure staple type of stock. If you look at their PE ratio, it's a 24. It's not too bad. Dividend yield is not bad, not super high either. So you'd want to see a little bit of growth because of the dividend yield being 1%. You're kind of combining that with, well, are you still at least around the S&P 500 potentially? Now, past 5 years, 76.69%, not too bad. Over the past year, pretty decent growth. And over the past 6 months, up 30.84%. So seems like they are trending in the right direction. You get a nice little dividend. It's not a whole lot, but it's something, and it's considered a consumer staple, which is something Warren Buffett likes to buy. Another one is Heiko, which was added earlier in the year and continued through Q2. Apparently, there's a stake of about 335 million shares. So they specialize in aerospace parts and defense systems. Because of global tensions, this could be kind of seen as almost like a war stock or something other than maybe Lockheed Martin, which a lot of people would think of immediately when it comes to a military-related stock. So you could also, if you want to diversify from something like Lockheed Martin, you could buy something like Heiko Corp. So you can see that they design, manufacture, and distribute components and systems for a range of industries, including aviation, defense, space, medical, and telecommunications. They do have a very high PE ratio, though. Obviously not the end-all, be-all for evaluating a stock. They do have some solid growth over time over the past 5 years and not really much of a dividend yield. So you're looking at this as more of a growth stock. You might be betting on, global tensions, making military stocks a little more attractive, at least for the next few years. Now, they did have a modest addition in Q2 for Chevron stock, which was about 3 to 3.5 million shares, taking positions to around $17 to $19 billion for Berkshire Hathaway. Obviously, this is one of the top blue chip energy stocks out there. I believe it's actually in SCHD, which is, again, one of the most popular dividend ETFs out there. They're kind of like the S&P 500 of dividends. But if you look at Chevron, you are mostly investing in them to be steady, maybe get a little bit of growth, but you're really looking at that dividend yield. When you look at something like Chevron, That's where the real money is with them. Although they do have some salt for a dividend stock, that's pretty solid growth over the past 5 years. Now, if you look at the past 3 years, you're not looking at much growth. So we don't know how they're going to do long term, but Chevron, I would say, I mean, you think of energy, you think oil and gas, you think of the current regime in the United States that's in power. I think they're a little more beneficial for an oil and gas company than, say, the Democratic side would be, which is more focused on clean energy. So maybe for this administration, Chevron could be a really nice dividend stock. You also have Constellation Brands, which is under the STZ ticker. So don't get it confused with Constellation Energy. It's a different company. They apparently increased their position in Q2 to 13.4 million shares, worth about $2.18 billion for Berkshire Hathaway. They are an alcoholic beverage powerhouse stock, basically. They're an American producer and marketer of beer, wine, and spirits. And they are the largest beer import company in the U.S., measured by sales, and has the third largest market share of all major beer suppliers. We don't know a PE ratio for them right now. They do have a pretty good dividend yield, though. So if you look at their growth over time, it's not good. They've had a pretty sizable dip over the last few years. Past 5 years, down quite a bit. It looks like in 2025, they've had a rough time this year, or over the past 365 days, down almost 42%. Then you also have Domino's Pizza. So Domino's Pizza, I think we all pretty much know what that is. It's pretty straightforward. They're one of the top pizza chains, founded in 1960, one of the top pizza chains in America. And as far as how many shares Warren Buffett has bought in them, apparently they added more shares, around 2.63 million shares, or about 1.19 billion in Domino's Pizza this year. Obviously a proven business model, delivery dominance, digital penetration, food ordered convenience with steady demand. There's a lot of competition out there, of course, for pizza, but they're one of the older ones. They're one of the biggest ones out there. PE ratio 27, dividend yield 1.49%. Are they really going to grow that much? I wouldn't expect them to. I mean, what is Domino's really going to do that's much different than they're already doing? But if you look at them over time, they're always going to be something that's probably fine despite whatever the economy is doing, whether it's good or bad. I mean, a cheap pizza, dominant stock is something that will probably always do at least something. It probably won't be going down. But if you want to maximize growth, you could probably do a lot better. Obviously not financial advice. The nice thing, though, is that you probably don't have to worry about it going down. If it does, it'll go right back up most likely, and then you do get a little bit of a dividend yield to go with it. So that kind of sums up what Warren Buffett bought according to Fool.com or Motley Fool, and it looks like he's going kind of the safer route, like more of the just staples of society, safer stocks that are maybe either underpriced right now, something like United Health that has for the most part a track record of growing a lot, and you also have just staples of whether it's leisure or advertising or energy, food, home building, healthcare, steel, that kind of stuff. They are looking for stuff that's stable. They're not looking for the shiny high growth stocks right now.